And today I'm going to be going into a short video about money. In this concept mapped here, I've got mapped out the different components when you think about money, and I'm going to quickly run through these before then going into more detail each thing. So there are two primitive instincts that are quite fundamental to human nature, and one is barter and the other is debt. So with barter, that's this basic human instinct of swapping things. So for example, I'll swap this fur coat for a couple of rabbits or something like this. It's obviously useful to humans to swap things, and this is the fundamentals of barter. And the other thing is debt, usual even outside of financial systems for people to borrow things off each other. So can I borrow your fishing rod? And then I'll give it back to you next week. So these are two basic primitive instincts that humans have. And the barter half of that, this develops into something called medium of exchange, where we have commodity money, representative money, and then eventually fiat money. So all of these develops stem from this basic concept of barter. And then in terms of debt, often casually people will record a debt mentally. You lend someone some money down at the pub or something, and you just remember till next week that they owe you that money, or it's their turn for a round or something. But then this has become formalized in human society, initially by use of things called tally sticks, and then after the invention of paper, through double entry bookkeeping and ledger books, and then the whole banking system has been established, where as economies expand throughout the world, this debt-based economy is then recorded using ledger books. And then eventually we started using computers for database ledgers. And moving forward, it looks like blockchain technology will take over for the optimum way of recording a ledger of debts and transactions. So to start with barter, and barter is the simplest form of trade, where, like in this example here, we've exchanged a coat for 3 sheepskins. And this is when humans are first evolving, and when you get groups of humans together throughout history, not necessarily as part of a large culture or a large society, barter's the first level of trade. And then debt is obviously a basic human instinct as well, where using memory actually you will borrow things off each other. So then money is the use of a medium of exchange for transactions and storing value. And the first beginnings of this are with commodity money. So the problem with barter, where we are just swapping different things we might need, is you get this thing called the coincidence of wants, where the problem is that let's say you're a farmer and you always have lots of sheepskins available. It might not be that everyone else in the village requires a sheepskin at any particular moment. And so that makes it quite awkward for building a economy, even like in a village economy scale. And so that's why commodity money comes into play, where there's a basic commodity. So for example, gold nuggets, let's say, where everyone in the village is going to want it. And so it becomes a convenient form of money that people can use to trade with each other. So throughout history, we see a progression from basic barter to the use of commodity money. Main examples given are the cowrie shells, which were popular in India and Africa and also China, beads, and in situations like in a prison, you find that people start using cigarette packets and even actually ramen noodles become a commodity money that circulates in prisons. So we see that there is this natural progression from just normal barter to the use of commodity money. The first commodity money we know about was invented by the Mesopotamians, and they used the unit of account of the shekel, which was a specific weight of barley, which was used as the first known about commodity money back in the year 2150 BC. And eventually most societies end up using gold or silver as the commodity money. So the Lydian kingdom was the first to mint these beautiful coins called electrum from about 591 to 560 BC. And these were actually a blend of gold and silver called electrum, which were the first coinage. And something to point out about money and commodity money is the money and then things then used as commodity money, they have certain properties in common, which is that they must be fungible, which means they're completely interchangeable, each unit, durable, so it's practical to use them over a long period of time, divisible, so that you can transact in different amounts, portable, so easy to move about, acceptable, so it only works as money if people are willing to accept it as money, and scarce, meaning that the supply is limited. So eventually, after the invention of paper and with the actual economies becoming larger, meaning it was actually impractical to use commodity money, we see this move into representative money. Now, this representative money is essentially using banknotes which represent a certain amount of that commodity money. So you could have a banknote for £5, and then you should be able to exchange that for £5 of silver, for example, at the bank. So that's why it's called representative money, because it's although you're exchanging just banknotes, that those notes are representative of actual commodity money stored at the bank. And actually, banking is from where this representative money occurs. It used to have initially it would be a temple, would be a safe place where people could store their commodity money, which back then could have been, say, gold or silver. And then the banks started issuing banknotes, or representative notes, which they could be used by individuals instead of the actual commodity money itself to transact with each other. So the first promissory notes, so that's notes which promise to pay the bearer on demand, were dated from around 118 BC in China, and they were made from a 1 foot square of deer skin. And then in China also they started producing paper banknotes called the jiaozi. I hope I pronounced that right. And they were used by the Song dynasty in the 7th century. And in Europe, we have the first European banknote was issued by the Stockholm's Banco in 1661. Here we have a 1732 £50 banknote issued by the Bank of England. And an interesting thing is that now we're used to banknotes only being issued by the central bank, so the Bank of England in the case of the UK. However, actually, when banknotes first came around in England, actually individual banks, private banks all throughout the country would actually issue their own banknotes. So these were their own promissory notes. They weren't issued by the Bank of England, they were issued by the individual private banks. And then it wasn't until there was a special law came into place banning any other banks apart from the Bank of England to issue new notes that stopped happening. But the banks that were already issued the notes were allowed to keep on doing so. And it wasn't until 1921 until the bank Fox Fowler and Company in Somerset, when they were taken over by Lloyds Bank, they became the last private bank issuing their own banknotes. With this here being an example of a £5 note from 1921. And then what happened was, in the 20th century, we had this switch over from representative money to fiat money. So in fact, even when we go back as closely as, say, 1971, the world did have actual currencies backed by gold or silver. Now, it was kind of tainted a bit because we had fractional reserve banking in place, and most of the countries were lending out more money than they had actually stored. But still, most of the money in circulation. So if you think of the British Empire, for example, um, most of that money was actually representative money, where it could be exchanged for a fixed quantity of gold or silver. And from the 1870s, we had introduced this thing called the gold standard, where it was standardized, this process. However, following the Great Depression, lots of the countries started actually becoming fiat and falling off the gold standard because the inflation was so bad, and you had the problem where people would actually run to cash in for their gold, so then there wouldn't be any gold left. That the lots of countries were forced off the gold standard, and initially, actually, the UK was the first to do this in 1931. And then, following the Second World War, the US remained the only country with a gold standard following the Bretton Woods Agreement. And the US dollar from then was the world's reserve currency, and it was actually pegged to a gold standard from 1944 until 1971, when even the US dollar had to fall off the gold standard, leaving us in a situation where all money in the world now is fiat money. None of it's actually backed up by anything. It's backed up only by the confidence that each individual country will be able to raise taxes in the future, and the fact that you're forced to use the particular currency in each country because the governments have a monopoly on violence, and the governments can say this is the currency you have to use as legal tender in each particular country. So this renders a situation where the the currencies being used throughout the world are all fiat, actually backed up by nothing. So there's two main kinds of money: medium of exchange, where this has progressed now to the fiat money, and then also money of account, which is based on debt. And actually, it's the advancements in the money of account that enables the situation we're in at the moment with fiat money. So if we go back to money of account, the first innovation is use of the tally stick. And so these tally sticks, well, the earliest in record is apparently this Ishango bone from the Congo, which dates to 20,000 years ago. Now, this is actually disputed. You would get things like actually the Babylonians storing records on clay tablets, etc., as well, predating the tally stick. But it's known that the Vikings used tally sticks, and also the medieval English did, and the Romans. And these tally sticks were basically where you would have a series of notches on a stick to record the debt. And then after giving the loan, you would snap the stick in half. The debtor would keep the half that was called the foil, which recorded the debt because it had the notches on it. And then the creditor would keep the other half, which was called a stock. And then that gave the term of the stockholder. And so whenever someone wanted to pay off their debt or claim a debt, you could prove the debt by matching the stock with the foil, as obviously the breakage would provide a kind of a unique way of validating that it was a correct match. And so tally sticks were used a lot in Europe as the economies grew, in the particularly say in the medieval period. But it was still a fairly kind of limited means to record debts. And then it wasn't until the Renaissance period where we had the invention of double entry bookkeeping and ledger books that the world economy started to reach a certain level of expansion, because this technology was able to handle a lot more debt throughout the system interconnected than obviously with tally sticks. So here's a Italian banking ledger from 1593, and double entry bookkeeping was invented by the Italian Luca Pacioli in 1494, and it became enabled by several inventions. Particularly paper had become reasonably inexpensive by this time, and also the invention of Hindu Arabic numerals, because this numbering system, which is the numbering system we use today, allows you to take away as well as add quite easily, and it's a lot more practical when calculating large numbers compared with Roman numerals, which is the numbering system we were stuck with previously. And in double entry bookkeeping, every transaction is recorded twice as a debt and as a credit. And so this allows money of account to be recorded and audited at a massive scale in a kind of international way. You could have large trading networks covering many different countries where individual debts can be validated using this system in a much more practical way than was ever possible before. And so double entry bookkeeping is regarded as the birth of capitalism, and it explains how the initial merchant banks originated in Italy, and how along with the Renaissance period we had this massive expansion of growth, knowledge, and prosperity originating in the Italian area, because it was the Italian city states from which this double entry bookkeeping technology originated. So, following the Renaissance period and the use of ledger books, we see capitalism expand, and really it reaches a huge size. The size of the world economy got so big that actually gold couldn't really cope, and representative money couldn't really cope anymore. We end up with fiat money, and then but still, even after the but still, say even in the 50s and 60s, despite a massive boom worldwide following the Second World War, we were still using ledger books. And if you were in one particular branch in the UK, for example, if that bank branch in your local town stored your information, it wasn't stored anywhere else. So any kind of transaction still had to be referenced across different branches, across long distances. So although we had the telephone, meaning it was a lot quicker, it was still kind of a bit limited. And then, of course, when computers came along in the 70s and 80s, that led to a huge increase in the size of the global economy, thanks to the switchover from double entry bookkeeping to database computer-based ledgers. So the example in the UK is Barclays Bank, who in 1959 they bought this EMIDEC 1100, which was initially stored in their headquarters. And Barclays Bank used this computer called the Burroughs TC500 in 1969, which only had 8K RAM. And this was the start of computerized banking, which obviously quickly developed into the fully computerized banking system that developed from the 70s all the way up to the end of the century. And actually, the size of the economy as a whole, it's mostly accounted for by money of account. Most of the money supply in the economy is actually debt in the form of money of account. So the majority of the world's economy is actually money of accounts, not medium of exchange form of money. The vast majority of money is debt. It's ledger book entries. And as we progress through time, the size of these have continued and obviously the move from books to computers enabled that. But fiat money is now only a small percentage of the total money supply. The vast amount of all money are basically ledger entries on computer databases. And it's likely that the next step in terms of money of account is going to be blockchain ledgers. In October 2008, Satoshi Nakamoto published the Bitcoin white paper. And it's a digital timestamp server where transactions are permanently recorded on the blockchain ledger. So once each new block is mined on the Bitcoin blockchain ledger, that's a permanent record. No one can ever alter it. And so that obviously makes it extremely useful money ledger, because you don't have to rely on any trusted third party. Anyone can go and verify whether or not that transaction took place after the fact. It doesn't rely on a trusted third party like a bank, because it uses proof of work, where lots of so-called Bitcoin miners use lots of energy to compete with each other to correctly validate the next block in the blockchain. And through this trustless system, we have a digital timestamp server or a blockchain ledger where all the transactions are recorded without requiring a trusted third party like a bank. And any two individuals can therefore transact directly with each other using the Bitcoin peer-to-peer electronic cash system without using a trusted third party. And like I've said, it's a completely open ledger, so anyone can then go back and check whether or not a particular transaction took place. So Bitcoin is a tremendous invention, which is clearly the next improvement over database ledgers, because you don't need to trust individual banks, because it's a peer-to-peer system maintained by a decentralized network. And so unlike the current system where there's lots of scope for corruption and fraud and people making mistakes and hacking and things, the Bitcoin blockchain ledger is a massive improvement on that. However, the problem is that the entire world economy is actually based on fiat money. So although the Bitcoin is actually a perfect replacement to the current financial system, there's no way that the current financial system will kind of allow it to happen. And so really it's marginalized as a kind of cult following thing going on in the background. But actually you require a kind of nuclear holocaust kind of situation, or World War III kind of situation before you could kind of see Bitcoin emerging as the replacement to database ledgers as far as the current world money supply is concerned. However, there are actually CBDCs and stable coins which are in existence. So CBDCs are central bank digital currencies. So in the UK, they've called this the Britcoin, and it's designed to replace pound sterling cash in the UK. Now, actually, a lot of people don't even really know about this, but the governments are working on this now, and it's highly likely that they're going to come out in the next few years, and actually cash will probably get replaced in our lifetimes completely by central bank digital currencies. Now, these use the same blockchain ledger technology as Bitcoin, but they differ in that instead of having proof of work, they're centralized. So they use the wonderful blockchain ledger technology, but rather than existing from this proof of work mechanism, they're just run by the government instead. The UK government, though, are clear that currently Britcoin will only replace cash. It won't be replacing any other of the money in the money supply other than just cash. And the other thing is stable coins. Now, stable coins again use blockchains technology which are centralized, but these, rather than being a replacement to cash, they're actually a replacement to private money. So currently, when a bank lends you money, it just digitally creates that on a computer screen. So what banks can do instead is use stable coins to digitally create the money. However, rather than being reliant upon a particular database, say on their centralized computer servers, the fact that it will be a stable coin will provide quite a lot of protection to those transactions, making them a lot cheaper and resilient to being hacked and things. Currently in the UK and the US and in Europe, the governments are establishing regulation for stable coins, and the intention is that the banking system will be using stable coins as well as CBDCs. So be in no doubt that blockchain ledgers are going to replace the current database ledgers. It's all in the works. However, rather than that being in the form of Bitcoin, it seems likely that the world government and the world financial system won't be using Bitcoin. It'll be using CBDCs and stable coins. But regardless of that, we can expect the future money of accounts within the world money supply to be using blockchain ledgers in the future. So that completes my video on money, having done some research into the matter. I think the main key takeaways for me on doing this work is that there's actually two forms of money. Money is the medium of exchange, money of account. And what's clear is that as the world economy has got ever bigger and bigger and bigger through time, we've seen medium of exchange develop eventually into fiat money. And at the same time, we've seen money of account develop into database entries. And actually, whilst in primitive societies, the majority of money is actually commodity money, medium of exchange, in advanced large economies like we have today, the vast majority of money is actually money of account, which is actually debt stored on database ledgers, with fiat money, which is essentially just cash mostly, actually quite the kind of minority of the money existence. Most of the money existence isn't notes in your hand, or even isn't really physical notes in your hands. It's a database ledger entry stored in your bank's computer screens. So that's really the main takeaway from this. And the next video I do is going to be looking at the money supply. I do videos like this one just for fun, as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.